Good afternoon. This is Michael Douville coming to you from beautiful Scottsdale, Arizona. It is the 31st of January, 2018. It's an historic time to be alive. Just unbelievable things happening. I have been talking ad infinitum about the risks that there are in the stock market, where retirees hold about 70% of their wealth is in the stock market. The other 20% is in the bond market. I've been really pounding the table about the problems in the stock market. Well, of course, 2 or 3 weeks ago, we talked about the bond market and how we have trend lines in the bond market and how we broke the trend line. And yes, and once the trend line got broken, why it's continued up. Today, the 10-year hit 2.75%, hasn't done that for 4 years. So rates are heading up. Now, why do we care? Well, listen, when you have zero interest rate policy across the globe, it's really easy for a little town in Germany to borrow $1 billion. It costs them next to nothing at 1/10 of 1% payback. Why it costs them next to nothing? Or maybe it's even negative. That costs them nothing to pay this back. Now it's interest rates going up, and let me tell you, they've gone up considerably. We've gone up from these negative to half a point, 0.65. Well, I'm going to tell you that's like 5-6 times what they were paying before. And of course, these municipalities across the globe in Germany and Bavaria, France and Italy, they can't pay. Look at the trouble that Chicago's having trouble. Puerto Rico, Illinois, New Jersey, Connecticut, Hartford, all these places. And we're talking about interest rates that are close to zero. Now where they're heading up, I mean, the interest rates, July 2016, the 10-year bond was at 1.36. Now it's at 2.75, better than a double in 2 years. And normal is like 5 to 6. So we have a long ways to go. So what that means is that the bonds, first off, as interest rates go up in bonds, the value of those bonds go down. Now let's talk about the credit risk. So as the interest rates go up, the ability of the municipality or the government or the sovereign to pay that goes down because they're paying at a higher interest rate. Obviously, if you're paying 2 3/4 instead of 1.36 on $20 billion, that's a lot of money. And of course, these guys just gorged and gorged and gorged. So they're having trouble, extremely low interest rates, and those rates are going up. When they go up, that means default risk goes up. And we're talking about sovereign bonds. We're talking about France. We're not talking about Greece or Portugal, who've just been in the news forever. We're talking about France, Germany, the Dutch bonds in the Netherlands. We're talking about the ones that people who are savers would go thinking these are conservative, and these are probably at risk. So you really need to pay attention to what's going on with that. If you're in any kind of global bond fund, you need to pay attention. Of course, at home, the same thing's going to happen. So when we're talking about bonds, we're talking about financing for a lot of these companies. One of the great big ones is HNA, which is coming out of China. They've been on this global buying spree. They spent $40 billion in the last 2 years, all of it financed. With leverage, they have virtually no equity, and they're struggling to make their bond payments. They own airlines, they own financial stuff, they own real estate. They own 10% of Deutsche Bank, and they're a major stockholder of Hilton reservations, Hilton hotels. So these people bought very, very good things, and now they can't pay their bills. The airlines are missing payments, and they're going to go into receivership. This is in China. And of course, there's 4 or 5 or 6 of these conglomerates. Steinhoff in South Africa just collapsed, and U.S. banks are going to take $1 billion in losses because of them. So let's just talk about those are bonds. So once this starts, it gets a cascading effect. So you really need to pay attention. Keep this in mind too. If you're a 10% holder of Deutsche Bank, you own 10% of Deutsche Bank, and you're in trouble and you need money to pay other bills, you're probably going to sell things that are liquid. What are all the other Deutsche Bank holders going to do? So if I were Deutsche Bank, I'd be pretty concerned about that. If one of the top, 10%, that someone owns 10% of your company, they're a pretty important stockholder. So if they say, hey, look, we're going to liquidate our position, what about those people who go 5% or 4%? They're going to try and beat them to the punch and sell out too. So look for Deutsche Bank to drop like a rock, because people are going to start. There are going to be some selling pressure, and of course this could cascade across the globe. So it's time to protect yourself. Time to pay attention. It's time to get into cash, get out of debt, build some reserves. If you have income requirements, we can still place I should say safer. Nothing is safe. This is safer. It should be very, very conservative, and we can get some consistent cash flow for you. And of course, we're in, Florida, Texas, and Arizona should be a phenomenal growth corridor. Here, we're in Maricopa County, number one in the United States, so we can still place some money. But listen, the main thing of this video is for you to really start thinking of maybe talking to your financial advisor about an exit strategy. Say at what point do we pull the plug? And of course, I keep saying you don't have to be fully invested all the time. Why do you have to have 100% of your money? Maybe you should take 70% off the table, take 80%. Leave still, say the market still goes up, I still have some participation. But if it drops, I'm not going to lose my shirt. And believe me, at my age, I don't want to lose 30 or 40 or 50%. God help me if it was 70 or 80 or 90. So listen, it's time to pay attention. And if we can help in any way, shape, or form, you're welcome to email me with my email at the bottom of this, and we can brainstorm, and we're here to help. So if I can help you in any way I possibly can, please call us or email me, and God bless you. Bye-bye now.